All right. Hey, everyone, and welcome to the first edition of Coffee with Chris. I am sitting here with our illustrious Chris Vanderwarker, MD, MBA, and we will be relying most heavily on the second degree for the series. There may or may not be some music after this, depending on how fancy I decide to get. Otherwise, let's just get started. So we're going to start playing with real money for the first time. So put away your airline credit cards and rip out $100 bill or something so you get inspiration. So this segment is called Coffee with Chris, and I'll just start out by asking Chris, what are you drinking today?
I will drink anything that has caffeine. Caffeine is a good thing.
And I've got my Venti Pike Place with 360 milligrams of caffeine in it, so I am a little jittery. So I'm going to let Chris do most of the talking. And today we're going to be focusing on investment products. So why don't you take it away, Chris?
All right, we're starting with this for one obvious reason, which is that as residents, you have a ton to invest. Oh, wait, sorry. That's probably not the case, but actually you probably do have far more to invest than you realize, individual circumstances aside.
Well, you're a popular guy.
The wife just can't leave me alone. That said, the reason I say this is that every single resident at the University of Washington has a very unique benefit that's actually quite special to our residency program, which is that the university will match funds that you contribute to your individual your 40 it's a 403b account, because it's done by a state institution. So if you elect to contribute 5% of your salary to this, the facility will match that 5% dollar for dollar. So if you're willing to give up $1, somebody will give you $1 for free, which means 10% of your resident salary should be being dropped every year into a tax-protected investment account. If you are not electing to donate money, you are passing up one of the only and true free lunches you have available to you. So we're starting with investing because the first thing you should be able to answer as you are listening to this is what percent of my salary am I automatically contributing to my 403b, and am I maximizing the amount of free lunch I can get?
And what's that free lunch? What number are they shooting for again?
5%.
5%. Okay.
There is a very, very limited number of reasons why you should not be doing this, and most of them involve extraordinary life circumstances that wouldn't be public for consumption. But almost everyone else should be dedicating 5% of your salary, and you should be going into your employee portal and making sure that that is the case.
So that should be your employee self-service portal. I think that's the one.
I believe it was called the ESS when I was there last. And I believe that you can change that number liberally. And many people would argue you should be able to contribute more than that. You can. For those who don't know, you are allowed, as of 2016, to contribute a total of $18,000 per year in a tax-protected manner to that particular account. Now, the university will only match the first 5% of your salary. So if your salary is $50,000 and you're committing 5%, that's $2,500. That's $2,500 free dollars that you're going to be getting from the university as essentially a raise, right? And then you can contribute more on top of that.
Okay, so we can contribute this. It goes into the account. Like NPR, there's a challenge and they match it, so it goes to your $2,500 becomes $5,000. Is that right?
That would be right. $1 for dollar, and then on top of that, you can contribute your own up to a max of $1,800 plus the facility's $2,500. So that's $20,500 per year in a tax-protected account if you're interested.
Now, is there any reason to go above the 5% that is matched going to this account?
So, yes, that's a great question, and there are great reasons to do it. These accounts are tax protected, meaning if you had a choice and you were going to put $1 of your money into a checking account at your local bank, or $1 of money into one of these retirement accounts at your institution, putting it into the checking account, well, you can transfer that to a brokerage and you can play and invest with that dollar. You will be taxed every time you do a transaction with that dollar. So if you buy a stock tomorrow and you sell it in a week, whatever gains you make will get taxed, and you will pay a capital gains tax on that transaction. If you do that within the safe confines of an account, none of those transitions, meaning you moving a dollar from asset A to asset B, get taxed. And that's free growth, because if your dollar turns into $2 and you sell it and move it to something else, you get to invest the entire $2. You don't have to take anything out of it and then reinvest that smaller remainder.
So it sounds like it's better than a savings account. So it's not as liquid as if it was a bank account, but it sounds like the rate at which it grows is better, and it's better than you playing the stock market on your own because it's tax protected. And these if you put that in there, these funds get invested, and that's how grow?
That's exactly right. So the power of this is really powerful for two people, right? People for whom they can set the dollar aside and have a reasonable expectation they're not going to need the dollar. You mentioned liquidity, right? You have to be able to live with not accessing this money for a decent period of time. There are some good exceptions to when you can access it, and people don't realize actually how well they really can access it if you do need it. But there's a lot of hoops and barriers and what have you on that side of it that aren't worth getting into. But if you can manage to put it in there and not need it, the magnitude of its growth will be dramatically enhanced by being firewalled away in this nice protected account. There are some other nice things about these asset classes that are particularly important as physicians. So most states, and again, this is a state-by-state issue, but most states protect dollars saved in retirement accounts from malpractice judgments. So you have this added little perk as being a future physician of having a free built-in asset protection scheme by saving a dollar in one of these versus in a savings or checkings or brokerage account outside of the tax protected world.
Gotcha. So it's kind of like almost a cyber safe sort of thing where you put your money in, you have to forget the combination for a period of time, but it's pretty much secure from anyone else, and on the inside it tends to percolate a little bit.
That's right. And one of the key things to know is that most accounts have particular dispensations for allowing withdrawals for the first time purchase of a home.
Oh, okay.
So for many house staff who aren't already homeowners, you can realistically think that you may be purchasing a home, and that would be a qualifying early withdrawal. Don't feel bad if you're only putting 5% away. I only put 5% away into one of these when I was a resident. Your salary is not big, and I'm sure everyone has places they want money to go. But putting their minimum of 5% in should be considered the basic standard. But now the question comes to you, what the heck are you going to do when you have money in a tax-protected brokerage account? So let's talk a little bit about investing. I believe that currently the default option for the University of Washington is put it into a life cycle fund. For people who don't know what a life cycle fund is, they are a fund that uses the different asset classes we're going to discuss now to manage risk for you. So that's a lot of big words. So let's talk about what the point of investing is quickly. So the number one point of investing is to have more money than when you started, right? The idea behind this is to create a situation in which you're using the effects of compound interest to take a dollar and make it much bigger over a period of time. There are a lot of things you can buy in the investment world, but the common ones I think everyone are going to know here, and I'm just going to stick to the really big asset classes. So you can buy stocks, which are essentially a share of a company. When you buy a stock, you become an owner. You are now entitled to a small sliver of all profit that company makes. You also, as an owner, are entitled to sell your stake in that company or sell your stock whenever you want. And if that stock has appreciated, meaning the company did well and got more valuable, you get to keep the difference between the purchase and the sale price. So there's two ways in stocks that you are making money. You're getting an income stream, meaning every time that company profits and turns out what's called a dividend, you get something. These are typically quite small relative to the actual stock. But then you also have something called capital gains, which means the longer you have the stock, and if the company changes in value in a positive direction, you get to keep the difference between your purchase price and your sale price. But stocks are pieces of companies. The second major asset class you have are bonds. Bonds are debt. They are mortgages for companies. The company is putting up the right. When you purchase a bond, what you are purchasing is a series of payments. So if you buy $1,000 bond, you are typically giving $1,000 to a company so that they can do something with it today. And the company is agreeing to give you a series of payments over the period of the bond plus a little bit of interest for the fact that you no longer have access to that $1,000.
So this is like you loaning money to the company? Is that
That's
how
exactly
that works?
right. Instead of actually owning a piece of the company, meaning you get the upside and the downside, in a bond, you are literally giving them money for them to do whatever they want with, and you're accepting as a promise a series of payments over a period of time so that you get back what you put in plus a little bit for your risk. Stocks are considered riskier than bonds. The reason why is that when a company goes into bankruptcy, stocks are unprotected, meaning if a company goes bankrupt, the stock value is zero and you're done. When they go to liquidate that company and sell everything it has, those proceeds go to pay off the debt holders, which are the bond holders. So stocks are riskier because you're the first person at the chopping block if something goes south for a particular company.
Gotcha. So they take your money that you've lost through the stocks to pay the bondholders. So the bonds are more protected.
So the bonds are far more protected, meaning a company not just has to lose the company has to lose so hard that the value of any assets they have left is not sufficient to pay the people that lent them money in the first place.
So you basically be looking for something like calamitous 2008 sort of financial meltdown.
That's exactly right. But you pay the price for that, meaning if you buy a stock and you buy it for $50 and you sell it for 400, you've made quite a bit of money.
Mm-hmm.
If you take that same company and bought one of their bonds during that same period of time, you're only going to get the 5 or 10 or 15 or whatever the percent interest you negotiated when you purchased the bond for the period of time. You're only going to get that no matter how well the company did. So if I bought Apple bonds in 2000, I would be happy that those bonds are still paying me the agreed upon sum today, but I would have nowhere near the wealth I would have if I'd bought Apple stock in 2000. This is relevant because I think, as I think you can probably tell now, stocks create the potential for much more rapid and serious income growth, but it comes with a caveat that when these little events like 2008 and the economic crash happen, you have a much higher chance of losing everything that you have. So now we've talked about two asset classes. We've talked about stocks and we've talked about bonds. There are three other ones that I think are worth mentioning very briefly. The first is probably the most obvious, and that's cash. So believe it or not, cash money is an asset class. Cash is liquid. Cash doesn't change in value. Cash can always be accessed. Cash is good. Where cash is bad is that you get very little interest on cash. Years ago, in a different environment, you might be able to put cash in a savings account and get 5 or 10% interest. Today, you are lucky if anyone looks at their checking account savings rate. I mean, you often see 0.12% for an interest rate on that cash.
Right.
Savings accounts, a little bit more generous, but very, very modest savings to cash. But it's safe. It changes in value relative to inflation only and is considered one of the most reliable places to put money you think you will need soon, but is probably not considered part of your retirement investment portfolio. Two things that do need to be in there, though, are the following. The first is a large class of investments called alternatives. Now, alternatives are anything you can imagine that's basically not stock, not a bond, not cash, and not real estate, which I'll talk about in a minute. But alternatives are things like gold and commodities. So the most common ones are things like oil and gold. There are a lot of reasons people purchase these. For a basic investor, you probably shouldn't be involved in purchasing alternative investments, right? They're typically have far more risk and a performance pattern that is difficult to understand relative to the other things you might be buying, and do not add tremendous value to a first-time investor. So focus on the stocks, the bonds, the cash, and the final one that we're going to talk about, which is real estate. So real estate, as you guys know, plays a huge role in our economy. Anybody who has paid attention to the news always sees real estate statistics, housing market growth rates, crash rates, whatever you may be looking at. Real estate is an important asset, and it's important because it does behave uniquely when compared to both bonds and stocks. What I mean by that is that real estate has a mind of its own, and historically, it has been a steady performer that has increased consistently. It's also something that historically was quite hard for an individual investor to buy. How on earth do I, Chris Vanderwarker, who doesn't have gobs of money, create a real estate portfolio without going into horrendous amounts of debt? Happily, the investment community came up with something called a real estate investment trust. Their nickname is REITs, R-E-I-T-S, and you can purchase them much like a bond or a stock. And essentially, you pool money with other like-minded investors to a group of people that professionally purchase real estate in whatever category you're talking about. And you reap the benefit of either the rental income stream or the capital gains associated with those real estate holdings. So stocks are buying pieces of companies, and you get to both get the benefit of the company's profit as well as the capital gains when you sell it. Bonds are debt when you give your money to a company that pays you a little bit for the privilege in the form of interest. They are more protected because if a company goes bankrupt, you are first cut of getting repaid. Real estate investment trusts, which are opportunities for individual investors to pool money and buy the right to rent or capital gains in the real estate market. And then cash and alternatives. So when you dump money into your let's say your $50,000 hypothetical residence salary, and you've now got $5,000 sitting in your 403B account managed by Vanguard or whoever is managing it, the question becomes, what the heck are you going to do with it? So the default answer to that has to do a little bit with why we care about these asset classes. And we talked a little bit about that when we talked about risk. But when you're investing, the two things that you want to understand are, what is my risk and how diversified am I? So you'll hear diversified a lot when you look at investment literature. Diversity means the more things that you own that behave individually, meaning that don't behave like each other do, the better the chance are that you will survive an epic calamity like 2008. So in 2008, if you had the unlucky coincidence of owning stock in Bear Stearns, which was a prominent investment bank that went under,
Rest in peace.
You now own nothing. Had you owned stock in, say, the 10 largest investment banks on Wall Street, you would have the unlucky circumstance of having your stock portfolio drop by, say, 50%, right? But you would at least have 50% of your stock portfolio left. If you, however, own stock in the top 10 banks on Wall Street, as well as stocks in industries across the country or even world, you may have only lost 20 or 30% of your portfolio value. Because as bad as Bear Stearns did, there are plenty of people who did make money during that time.
Watch The Big Short.
Watch The Big Short. So we care about diversification in investing. We care about correlation, meaning how likely is whatever you purchased to behave relative to the other things you've purchased. And we talk about risk. So when you are investing, what financial advisors will ask you is, how diversified are you? How correlated are those different items? And how much risk are associated with them? The rule of thumb is this: you get paid for taking risk. Risk is expensive. Risk is dangerous. The more risk you take, the more reward you can get. The more risk you take, the more you can lose. When you are young, the rule of thumb is that you can absorb a lot of losses, because over time, the premium for taking risk, meaning the extra bit you get paid, will outweigh the amount that you lose. And that has historically been true. So generally speaking, a life cycle fund, which is where most of your money, when you put it into a 401(b) will go by default if you don't select it to be different, tries to assemble a risk and diversity portfolio that matches the expected retirement age you have. So most of these funds are named by when they think you will retire. So for instance, you might choose a fund that is the life cycle fund for 2045. What that means is that as the date 2045 approaches, the fund changes the risk and diversity of the holdings to reduce the chance that in a catastrophic market event, the holder of those funds would lose all their money. Early, when 2045 is still a long way away, the funds have a weighting that is skewed towards high-risk, high-return investments to maximize the opportunity for your money to grow. They make a ton of sense. For a lot of people listening to this, I would say that that's probably all you need to know. There are stocks in there's bonds in there's usually real estate investment, there's usually cash, there's sometimes alternative investments. They're put in there. They start off quite risky, meaning if the market goes up, you go up. If the market goes down, you go down. And over time, they become far less risky. Where the market goes up, you get a bit of that, but the market goes down, you only lose a little of that. And it does that so that if you are planning on retiring in 2045 and there's a market crash in 2044, you don't lose everything.
Okay, so basically, when you see something, you'd have to go a couple of websites, I think, to get to the ability to choose the specific funds in these things.
So when you sign up for your 403b account, when you sign up to create a match at the University of Washington, they will ask you what percent of every tiny little bit that you throw into this do you want going to fund X, Y, or Z. And I believe the default options are a life cycle fund roughly equivalent to your age, right?
Right. I do remember seeing 20XX in there somewhere.
Right.
Yeah.
And largely speaking, for good reason, they, meaning financial advisors at institutions with integrity, are steering clients who don't care about investing and are happy just making sure they're not losing and being the sucker. As long as you don't mind losing and being the sucker, put your money in there and rest assured that you're not missing out on anything and you're doing everything right.
Okay.
You can stop listening now.
Okay. So that generally for everyone, that is a good, safe approach to put your money away and make it grow for your retirement is maximize the max that's available. If you have some amount of money that you want or you think you can part with and not use, you can put that extra in there, and then you can pick one of these life cycle funds, and that should be pretty solid advice.
You can rest assured in a life cycle fund that you're at least going to capture market return, meaning your money is going to go up and down with the money of the nation, and you're not going to get left behind.
And typically, the nation grows in wealth.
Thus far, the nation has done well, and you would have done well.
Okay, great. It's getting to about 22 minutes in this episode. Why don't we cut it there? Any last thoughts, Chris? And then next time we can maybe move on to another topic, or did you want to say anything else about this particular topic?
Good luck investing. Use the life cycle funds unless you have a lot of disposable time or you have a lot of investments in alternative accounts and need to do something to correlate those more rationally. Life cycle funds are your friend. Perfect.
All right, everyone. We'll see you on the next episode of Coffee with Chris. But until then, happy investing, and may the force be with you.
Take it to the nearest star.